So the most important, I want to also point out this is a joint paper with Paul Willen, who is seated safely in the back row in the back and can help me answer any difficult questions. It's very important, though, that I point out that as Paul and I are both employees of the Federal Reserve Bank of Boston, these views on mortgage default and other things are our own views. They do not represent, well, they may, but they do not necessarily represent the views of our boss, Eric Rosengren, or the big boss, Jay Powell. So it is not surprising that the editors of the ARFE for 2018 would want a paper on mortgage default, because we certainly saw, as you all know, a large increase in mortgage defaults during the recent recession. 90-day defaults, 90-day delinquencies, which typically do not move very much in recessions, rose with a vengeance in the most recent recession. And a natural question that economists have is, why were there so many defaults? But when you frame the question in that way, you're really asking, why did we have a recession that was so closely tied to the housing cycle? Why did we have a housing cycle to begin with? And there are common explanations for that. We'll talk more about them later. Were there a lot of unaffordable loans that were originated that later went bad? Were there distorted beliefs or over-optimistic beliefs about housing prices that encouraged lenders to make a lot of loans that went bad? That's actually not the right way to frame this issue, to frame this question, if you're standing from the vantage point of a mortgage default researcher. If you're coming at it and ask, what influence does this green line, these increase in defaults, have on the mortgage default literature? There, the right question is really why we had so few defaults. And by few defaults, I mean so few defaults conditional on the collapse of housing prices that we saw before and during the Great Recession. So on the left panel, the blue and red lines show you HPA, house price appreciation, the rate of change in housing prices over time. That typically declines in recessions, but it declined with a vengeance in the most recent recession. On the right, you see the fraction of homes, according to CoreLogic, that had negative equity or near negative equity. LTV ratios of 100%, equal to or greater than 100%, or greater than or equal to 95%. And if you can't see the numbers, in 2009, we had about a quarter to a third of mortgaged households in the United States that owed more on their homes than their homes were worth, that had negative equity. And as you know, negative equity is typically a precursor of default, but a third or a quarter of mortgages in the United States did not default. The number of defaults was much, much lower than that, as you saw in the previous graph. Now, theoretically, as it turns out, the benchmark model that we use in the mortgage default literature, the frictionless option model, is qualitatively consistent with the fact that a lot of borrowers with negative equity do not default. And this model, which has been developed over the last several decades, comes out of applying standard option pricing techniques to the borrower's default decision. Now, the graph I have up here is from the paper. We're very proud of this graph and the MATLAB program that generated it. I'm not going to go through it in detail, mainly because I don't really want to explain option pricing when Robert Merton is sitting in the front row. But for my purposes, it's enough to really give you the intuition of what this frictionless option model is all about. Now, it starts with the assumption, as you might guess, of frictionless capital markets. Someone who has a mortgage can also freely borrow and lend outside of that mortgage arrangement at the risk-free rate. There's no limits to short and long positions, and we sort of have the common treatment of stochastic processes for house prices and interest rates. They're volatile, but there's a no arbitrage condition that sort of pins them down. Now, what's the implication of this setup? Well, the implication is that once borrowers get a little bit of negative equity, if housing prices fall a little bit below the value of their mortgage, they don't instantly default. Why? Because there's an option value of waiting to see if the housing prices recover. And default only occurs when the amount of negative equity reaches some level that's so deep that in a precise sense, it's really not worth continuing making the payments in the hope that the price will go back up again. Now, in 2008, along with Chris Girardi and Paul Willen, the three of us wrote a paper that used Massachusetts data from the early 1990s, which had gone through a house price decline at that time, to show that we could actually measure using deed registry data how many mortgage borrowers in Massachusetts had negative equity, and we showed that over time only about 10% of those homeowners lost their homes. So we were, score one for the frictionless option model. We also sort of wrote down a simple two-period model to express some of this intuition. Now, that's not the end of the story, though, because problems come when you move from qualitative statements generated by the FOM about default to quantitative statements. What happens when you actually calibrate the frictionless option model with a reasonable variance of housing prices? How big is that region of negative equity where people aren't going to default? And I'm going to illustrate this with a graph here. So this is comparing the default function as generated by the FOM. I don't know if I can really point here, but as you move to the right into the blue region of the graph, you're moving to a higher LTV ratio, and once you pass 100%, you're in negative equity land. You don't default according to the FOM right at 100% negative equity. You default at some positive or some further value of negative equity. That's where it says FOM default threshold. But at that level, boom, your probability of default goes all the way up to 1, and at very high levels of negative equity, you default. Now, how big is that FOM default threshold with reasonable parameters? You're typically looking at something like 110% LTV, 115, 120. It's hard to get that to be 150. All right, so that's sort of how we think about things quantitatively. Now, the blue and the red lines there are sort of empirical default functions with borrowers of different types of credit scores. That's not so important, the difference between the blue and the red. The important point is that empirically, the default function looks like there's a lot of people who have very high levels of negative equity that are not defaulting. And in the literature, those are attributed to transactions costs. And transactions costs are to mortgage default researchers what dark matter is to astronomers, right? It's all the stuff we really can't quantify and really don't know about. It might be the stigma that you get from defaulting, the hit that you get from your credit score, having to move your kids into a new school. Whatever it is, it's a cost that depresses the empirical default function below what you would get from the FOM. That's problem number one. And we've known about these these transactions costs going way back to the 1980s. Nice paper in the Journal of Finance by Buddha shows that they're relevant for the current crisis as well. Another problem is that borrower level characteristics seem to matter for default. And I illustrate here with sort of characteristics of a borrower's credit score. But an easier way to think about it is think about a borrower who loses his or her job, or who gets divorced, or who gets sick, who suffers some sort of adverse life event that makes it hard for them to keep up with paying their mortgage. In the frictionless model, remember, those borrowers can borrow and lend freely, even outside their mortgage arrangement. So if the borrower loses the job, the borrower just borrows and takes a loan, and that's that. If the FOM says they should continue to pay, they continue to pay. In the real world, however, borrowing constraints limit the ability of borrowers or mortgage borrowers who face or suffer adverse life events from taking those types of loans. So what happens? Borrowers who suffer adverse life events often default. Now, when we think about the effect of adverse life events on default, we're led to sort of a different approach to thinking about default, and this is the famous double trigger model. So on the left panel there, you have a very simple or basic treatment of the double trigger model, which says default occurs when two triggers are pulled. First, the borrower has to be in the left column so that they have negative equity. Borrowers who have positive equity don't default, they just sell their house no matter what happens and pocket what's left over. The top row, though, the second trigger is the top row says the borrower also has to suffer an adverse life event. So both of those triggers get pulled. According to the double trigger model, the borrower is going to default. The other panel there, panel B, shows a more sophisticated or what we call the modified double trigger model. And in that model, you might think that there's a little bit of optimization going on, such that if you're in the upper right corner of that triangle, you've got low negative equity. You basically have almost positive equity. And so it's going to take a very big income shock for you to default. If you're in the other corner, you've got very deep negative equity, so it may take only a small adverse life event for you to default. And so when we start thinking about the modified double trigger model, what we're trying to do is really kind of blend ideas from the frictionless option model, which sort of really stresses negative and only negative equity, to adverse life events. And that really takes us to the, I'm going to actually skip this, that actually takes us to the research frontier. What are the papers in mortgage default that are appearing in journals trying to do today? Well, they're trying to write down models in which expectations about future house prices matter, as implied by the FOM. They may try to sort of adjust the way that expectations are formed so that they might be non-rational in some sense. They might sort of expect mean reversion. So what do I mean by that? Well, here are some graphs of house prices for the US as a whole and 3 of the so-called sand states. Arizona, Florida, Nevada, and California is not on there. So if you look at the upper right panel there, that's for Arizona, you see that Arizona had a big decline, but then there was a non-trivial recovery in prices after that. What would a borrower do if they were sitting in the trough and they sort of knew, really what happens after crashes is that the prices crash, but typically there's a period at which they are more likely to rise than to decline. They would therefore be more likely to hold on to their homes at any given level of negative equity. That would be consistent with what we find, is that the default is less prevalent than a pure frictionless option model would suggest. Third sort of thing that people are trying to do in these models is that they want to show that there are borrowing constraints, or at least allow for borrowing constraints, so that adverse life events matter, and that most borrowers are going to remain current on their loans even when negative equity is deep and or liquidity constraints bind because of these amorphous transactions costs that we don't know much about, but that we'd like to know more about. Now, that's sort of the whirlwind tour of kind of how the mortgage default research is now progressing given what we've sort of had in the crisis. I next want to talk about, before I leave that, I want to say that over time, the data to test this model is going to probably get even better. Most people working in the mortgage default literature empirically are using loan level data on millions of observations. Ideally, though, we'd like to have a data set that is large like that, but has information not on only how the mortgage is doing, but what else is going on in the borrower's life. It would be great to know, for example, on a month-by-month basis, how much income that borrower has. Not too many data sets like that, but some of those may come online later on. Okay, so the organizers of or the editors of the journal, I learned today that these papers are supposed to be reviews with attitude. We weren't told about the attitude part. We were just told about the review part. But I think the next section has a little bit of attitude in it, because what we do in the paper, in 3 areas of the paper, is talk about how lessons from the mortgage default literature could be very relevant for important questions related to policy in the financial or in the foreclosure crisis, and also relevant for sort of why the crisis happened to begin with. So one question is, should the government have written down mortgage principal more aggressively? And there's also ones about the patterns of defaults and the potential causality between foreclosures and house prices. So the first one was, there was a lot of debate about how the government should try to prevent foreclosures during the acute phase of the crisis, and specifically whether or not the government should try to reduce principal, mass write-downs of principal, or to focus on reducing the current monthly payment that borrowers have to pay. And what they eventually settled on with HAMP was really policies that were targeted mostly on the payment reduction side, not mass reductions of the principal that they borrowed. Now, we think that's a good idea because the key problem with principal reduction as an anti-foreclosure strategy is it really doesn't work that well no matter what type of default you're trying to prevent. So think about a double trigger default. The whole point about double trigger defaults, or the whole thing that sort of gets them into the model, are liquidity constraints. The idea that $1 today is worth a heck of a lot more than $1 later on. Well, what does a mass write-down of principal do? It basically means, hey, when you sell this house, you're going to get a lot more money in your pocket later on. And that doesn't help you too much in the present. And there's a great paper in the Brookings series by Eberle and Krishnamurthy which really draws this implication out. Well, what about principal reduction as a way of reducing just pure strategic defaults that would be implied by the frictionless option model, defaults that occur just because negative equity is very deep? Well, there the transactions costs come into play because the very low default rate among non-stressed borrowers or borrowers that haven't lost their job or suffered any adverse life event means that mass principal reductions aren't going to be cost effective in preventing those defaults. There might be a lot of people with negative equity, very deep levels of negative equity, but empirically, few of those people actually default. The data show in papers that are coming out now, one written by Paul and a co-author, Andreas Fuster, do show that payment reductions that reduce that are sort of caused by, for example, interest rate resets. If your interest rate resets down such that your payment is reduced by a large amount, lo and behold, that has a very significant impact on your default frequency. However, as a matter of policy, the important thing to keep in mind is that any anti-foreclosure program is going to have an imperfect information problem. Everyone's going to want to say, yes, I can't pay my mortgage this month, I need a reduction, or yes, I've got negative equity, I'm going to default. But in reality, not everyone is actually going to default, and that makes things a little tricky. So the second question involves default patterns and the underwriting standards as the ultimate sort of cause of the crisis. So there were a number of early papers in the literature that used patterns of defaults among marginal borrowers to sort of point to this idea that the crisis resulted in large part from sort of an exogenous increase in bad underwriting through securitization or whatever. And we talk about these papers a lot and sort of discuss some alternative interpretations of their findings. I think now recent work is showing that the problems in the mortgage market were widespread throughout the income distribution, and certainly this is what Antoinette is going to talk about, and that there's a new narrative that links the housing cycle to distorted beliefs about asset pricing rather than securitization or bad underwriting. But a lot of this research that has sort of, in thinking about defaults, can kind of help us with this. In 2012, with Chris Girardi, we pointed out that if you look at the people were talking about subprime defaults and the resets of subprime defaults to higher interest rates were causing a lot of defaults, we talk about how in the paper 89% or 88% of people who ultimately defaulted did so paying the exact same payment they made at origination. And so if you look at the paper, you'll see a lot of discussion of defaults and the patterns of defaults and show how they may not be consistent with the conventional wisdom, but could be consistent with the story about beliefs. So finally, there's a lot of talk about the effect of foreclosures on house prices. Pretty much everything I've said up to now talks about how declining prices can lead to more foreclosures. Well, could there be causality going from a wave of foreclosures causing house prices to decline? And we have a long section, well, not too long, but a thorough treatment of that question in the paper. Now, it is true, and theoretically, foreclosures do reduce the set of potential home buyers. But unless those folks who get foreclosed on go live in caves, foreclosures also raise the set of potential renters, and therefore rents. And so therefore, with higher rents, that encourages landlords to go buy those homes and convert them to rentals and rent them out. Now, a key question here, and that is sort of having a dampening effect on any decline in prices that would come from the initial wave of foreclosures. Now, a key question here, and that's also relevant for a lot of other issues, is how separate the owner-occupied market and the rental markets really are. How easy is it to turn a house that is owned into a house that is rented and vice versa? But in any case, in the data, you actually see when housing prices stabilize was precisely the time in which there were a lot of completed foreclosures, going out on the market. So our view is that theoretically this is possible, that you may see foreclosures affect housing prices, but the existence of landlords and the data, landlords in theory and the data suggest this is not really a big channel. So the bottom lines of our paper, just as the Great Depression sort of stimulated macroeconomics, we think the Great Recession has very significantly stimulated research on mortgage default. The basic patterns, though, were consistent with what any default reacher would have told you circa 2002. If you're going to have a big increase in defaults after a house price collapse, that's not surprising. The vast majority of people with negative equity are not going to default, and as a result, that has big implications for policy to prevent foreclosures, making it difficult. Going forward, researchers are going to try to blend the FOM with the double trigger models, and here the treatment of price expectations is going to be critical. Do borrowers kind of have over-optimistic views either in the boom or after a big trough? And empirical work is really going to be helped by more big data coming online. I would want to say, though, that when you see a bunch of defaults going on, it is a feature of risk sharing in our economy. And we close our paper with a discussion of very important papers that say, under imperfect markets, if you can't specify outcomes for a mortgage payment at every point in time, given what's happening with a borrower, defaults may be the best way we have to share risk. And with that, I think I'm out of time.